There are a couple of price movements that repeat over and over again in the market. The Eliott wave theory calls these price movements waves. The Eliott wave theory is a rather complex theory that takes a long time to master. But fret not, because in today's video, I will share with you some elements of Eliott wave that you can start implementing right away into your trading strategy. I will simplify the Eliott wave theory and show you how you can forecast price action with the Eliott wave trading strategy. We are currently doing a giveaway for our premium Forex signals. So what you have to do is look for an emoji in this video, and once you find that emoji, comment below the emoji plus Forex signals. And you can potentially win lifetime access to our premium Forex signals. We will announce the lucky winner in the next video, either in the video itself or the comments section as a pinned message. So make sure you subscribe and hit the notification bell to know when the next video comes out and whether you have won. The first concept of the Eliott wave theory is the impulsive and corrective waves. Ralph Nelson Eliott, the Eliott waves theory creator, suggests that the markets move according to the masses' predominant psychology. He argues that the same recurring patterns, or what he calls waves, occur whenever there is mass psychology. There are impulsive and corrective waves. Knowing which wave is currently happening and what waves occurred recently will help you forecast what price is likely to do next. Sounds confusing? I promise that it will all make sense shortly. First, let's define what an impulsive wave is. It is a large price movement in a singular direction. An instrument keeps trending higher whenever the moves up are larger than the moves down. Of course, the opposite is similar for an instrument trending down. The corrective wave, on the other hand, is smaller waves that occur within a trend. If you are confused, think of a corrective wave like a retracement in an existing trend. Understanding both impulsive and corrective waves, it should be clear why we want to lean towards the direction of the impulsive waves and trade them rather than the corrective waves. Impulsive waves provide a higher probability of making a large profit compared to corrective waves. But that doesn't mean that the corrective waves are useless. You can use the corrective waves to enter into an existing trend and attempt to capture the next impulsive wave. Here's an example of what I mean. In an uptrend, you want to be buying when there are corrective waves, something like this. You want to attempt to catch the next impulsive wave before it happens. Impulsive and corrective waves can also help you to determine when a trend is about to change. If you see a price chart that shows a big move to the upside, followed by small corrective waves in between, and then a large movement in the opposite direction, that's a sign that the uptrend may be over. Now, why is this so? Well, because you would expect the impulsive move to occur in line with the uptrend. But if you see a big move to the downside, a move that is bigger than the prior corrective wave, that hints that the market is no longer that bullish. And that's the first concept of Eliott wave that you can incorporate into your trading. I will now break down the exact 5-wave pattern that will help you pinpoint if you should be trading with the trend or consider a counter trend play. This will help you to manage your trades better and take better trades, so make sure to keep watching. The second element of Eliott wave is that price usually moves in a series of 5 waves, 3 large impulsive waves and 2 corrective waves. A 5-wave pattern consists of an impulse, a correction, an impulse, another correction, and another impulse. These waves are labeled from wave 1 to wave 5 respectively. After completing the 5 waves, Eliott wave theory states that it is followed by 3 waves: an impulse down, a correction to the upside, and then another impulse down. These waves are labeled as A, B, C. One thing to note about this pattern is that they are fractal, meaning that the same patterns happen on smaller time frame and larger time frame. Therefore, there is no perfect time frame that you need to stick to when applying the Eliott wave theory. Here's an example to illustrate this point. The last impulsive wave within an uptrend on the daily chart could be comprised of 5 smaller subwaves on an hourly chart. Note that this doesn't always happen. I'm just trying to illustrate that these movements can be fractal. Also, corrective waves can be made of 3 smaller waves if you view them on a shorter time frame. Remember the waves labeled A, B, C that was mentioned earlier? Understanding the price structure of these is essential as it can help you determine when to enter a trade. Assume that you spotted an impulsive move to the upside. You can reasonably predict that a correction is likely to follow. And how will this correction occur? Well, if you have been listening, then you should expect the correction to unfold in 3 waves. An impulse down followed by a small rally and then another impulse down. You can use this knowledge to improve your trade entry and timing by waiting for the second drop before taking a trade in the direction of the main impulsive move to the upside. I hope you see the power of understanding how the Eliott wave works. But wait, there's more, so keep watching. Recall earlier that after 3 impulse waves up, then the uptrend may be over and the price is likely to do a 3-way correction? Well, you can use this knowledge to exit your long positions or use this as a sign to stay out of the market if you do not wish to trade the counter trend. Now, the next concept about Eliott wave has to do with the size of the correction. Earlier on, I explained that you should be buying on corrections or pullbacks in the impulsive movement direction. It is helpful to understand how large the typical correction is, so I want to explain this to you. It will help you identify the different waves quickly. Based on the 5-wave pattern, wave 1 is the first impulsive wave of a trend, while wave 2 is the first correction. Wave 3 is the next impulsive, followed by wave 4, which is a corrective wave. Finally, we have the last wave 5, which is an impulsive wave. Based on Nelson, he found that wave 2 is typically about 60% of the length of wave 1. Suppose an instrument goes from $10 to $20 in the first wave. That's a gain of $10. Based on this, we can expect wave 2 to be about $6, essentially for the price to drop about $6 to $14. After wave 2 comes impulse wave 3, the wave that is often the largest, much bigger than wave 1. This is an excellent way to identify what wave price is currently at. Simply identify the largest wave of them all and then start counting. After wave 3 comes wave 4, and wave 4 is usually about 30% the size of wave 3. Suppose an instrument rallies from $10 to $20 in wave 3. Then you will expect the price to drop $3 to $17. It is important to note that these values are averages and should strictly be used as a reference. You should not take these values as absolute and insist that price should move in that way. These values apply for both bullish and bearish scenarios, and you can integrate these concepts into your trading strategy to sharpen your trade timing and entry. Earlier on, I simplified the labeling of waves for you. In reality, labeling waves isn't that straightforward. So right now, I want to provide you with some guidelines to take in mind when labeling your waves. Get this wrong and you will arrive at a different conclusion. So labeling your waves correctly is very important. So make sure to keep watching till the end. Guideline number 1. Wave 3 should always be the longest impulse wave. Earlier on, I mentioned that using wave 3 as an anchor to identify all other waves is a great way to start counting waves. Impulsive waves 1 or 5 should not be longer than wave 3. In an uptrend, the high of wave 3 should not be higher than that of wave 1, meaning that price has made a higher high. The converse is also true. In a downtrend, the low of wave 3 should be lower than that of wave 1, meaning that price has made a lower low. If this is not true, you have to re-evaluate your labeling and check if you identified the waves correctly. Guideline number 2. Wave 2 should never exceed the start of wave 1. To put it simply, wave 2 cannot retrace more than 100% of wave 1. If you see a break above or below the start of wave 1, then you need to restart your count. Remember, wave 2 is meant to be a corrective wave, like a retracement. If it breaks the start of wave 1, then it isn't a retracement anymore. Guideline number 3, wave 4 should never cross into the price range of wave 1. In a bullish example, the low of wave 4 cannot go below the high of wave 1. Conversely, in a bearish example, the high of wave 4 cannot go above the low of wave 1. If this happens, then you need to recount. Now, the first 3 guidelines are guidelines that you need to follow. You can view them as rules. The next set of guidelines are not always necessarily true, but they can help you better identify the different waves, so keep watching. Guideline number 4, when wave 3 is the largest impulsive wave, the length of wave 5 should be relatively equal to the length of wave 1. Guideline number 5, the price structure for wave 2 and wave 4, which are the first 2 corrective waves, tend to alternate between sharp and flat. This means that if we see a sharp correction in wave 2, we would likely see a flat correction in wave 4. If we see a flat correction in wave 2, then we will likely see a sharp correction in wave 4. Guideline number 6. After the impulsive wave, wave number 5, the subsequent ABC correction usually stops somewhere near the area of the prior wave 4 low. And these are the guidelines that will help you get started. Now you can see that it isn't simple. Worse still, this is only the theory. The application portion is where the real challenge is at. Now that is why I stress the importance of incorporating certain Eliott wave elements into your trading analysis and not necessarily basing your entire trading strategy on Eliott wave. Concepts like impulsive and corrective waves and trading in the direction of the impulsive waves are things that you can start incorporating into your analysis right away. You also want to pay attention to the impulsive waves direction since it is a good signal of a potential trend change. Combined with the 5-wave impulsive or 3-wave corrective pattern, this can be a very strong signal. These concepts will improve your analysis and help you time your entries and exits better. However, I want to reiterate that Eliott wave and wave counting can be really complex. Hence, I do not recommend that you use it in isolation. You would probably also notice that I didn't cover how to trade Eliott wave on its own. I do not provide any specific rules of entry or exit. Furthermore, wave identification can be very subjective and 2 traders may arrive at a different conclusion. So this video introduces Eliott wave and provide you with some key concepts to start applying today. If you enjoyed this video and like me to go deeper on how to apply this to day trading or even swing trading, please leave a comment below to let me know. My team does read through the feedback when considering what videos to make. I hope you learned something useful from this video. Like this video, subscribe to this channel and comment with the emoji plus Forex signals to enter yourself into our giveaway. The winner will be announced in the next video, so turn on the notification bell and check to see if you have won. I have also prepared a free day trading guide which you can download via the link in the description below. Thanks for watching and I'll see you in the next video.